Michelle, what does this data show and how should people be reacting to it?
Sure. So I think it's very clear that there is this big kind of mismatch between demand and supply. Demand is extraordinarily strong. Consumers are out spending at a rapid clip for all kinds of products, whether it's durable goods or services spending. And meanwhile, businesses are investing and trying to keep up with that demand and increase their capacity. But there's obviously some real challenges there, and that's creating these price pressures, which were evident in today's jobs report, and it's evident in the inflation numbers as well.
So we're talking about price pressure, but there's also wage increases. I've been seeing all these stories about, hey, how much the summer jobs are paying. It's a good time to be a teenager looking for work. Some of the inflation might be transitory. Are the wage hikes also transitory, do you think? And is that going to affect how much people are willing to pay for things as the year progresses?
Well, look, yeah, I mean, there's similar dynamics in the labor market as there are in the broader economy, which is that there's an incredible amount of demand for labor. We see that with the job openings numbers. And there's some friction in terms of getting people back in the labor market into the jobs that would best suit them. So I think the increase in wages, particularly what you're seeing on the lower skilled part of the labor force, seems to be partly a function of this, and it's probably going to slow down. I don't anticipate we're going to see wage growth of this magnitude much longer. That said, I do think we need to be careful with how we characterize transitory. You know, transitory could last for a few months here, if not quarters, given the incredible imbalance in the economy right now. And the longer that you get these price increases, particularly the larger those price increases are, the more it starts to set into expectations and can threaten to be more persistent.
So does this at all shift the math on when we get a taper from the Fed?
You know, I don't think it's going to really change the timeline too significantly, to be honest. I think that the Fed is setting up very nicely and carefully for a change in the balance sheet for tapering, which in the next few months, I think is still very much a function of the success in the labor market rather than this, kind of inflation narrative. I think the inflation trajectory will really influence the timing of rate hikes and the speed of those rate hikes. But I think for tapering, it's about making sure that there's sufficient growth, broad-based enough growth where you can start to pull back on those asset purchases. And to me, they're starting the baby steps in setting the stage for it. And I think that throughout the summer, we're going to hear a little bit more around the taper, a bit more details, nothing concrete. And then in the fall, particularly that September FOMC meeting, I think if all goes as planned, they'll be able to send a more explicit signal at that point.
Okay, now let's go a little bit more micro again, get back into that credit card data. A year ago, consumers were binging on toilet paper, right? But now entertainment services, is this like the flip side of I've been cooped up, all year with my closet full of toilet paper. Now I want to get out and have some fun. Is that what the data is showing?
Yeah, I mean, to some extent, yes, it is. You certainly are seeing consumers want to go back out and live their life. And as you noted, our core data shows a pretty impressive increase in entertainment services spending from the beginning of the year. And there's still a lot more to go in terms of catching up in that category. You're seeing restaurant spending in the order of almost 20% on a 2-year growth rate, travel picking up in a meaningful way. And what's interesting, and I think very important, though, is that you're still seeing consumers spend on some of these durable goods they've been buying. They're still going out buying at home improvement stores, furniture, electronics, clothing. So, there's been so much talk about all the excess savings that's happened. And now I think we're seeing, in a sense, excess spending across categories. And there's more room to go in that front in my read of it.
So what are the anomalies that you're seeing here? Are you seeing anything in this data that's like, well, consumers usually don't spend so much on that, or there's no way this is going to last, or, hey, this is brand new?
Yeah. Clearly the magnitude of the increase is unusual. These are dramatic increases in a number of categories, as you noted, particularly things like entertainment, leisure, because we're bouncing off of such low levels because it was depressed as a result of the pandemic. So, at some point, it starts to become challenging to see growth rates continue at that magnitude. You start to reach a level where spending is kind of normalized or above and beyond normalized and you start to see some moderation thereafter. But, I think it's a sign that consumers are going back out, they're reengaging. And I think that there's a lot more of that throughout the summer as virus numbers continue hopefully to go down and people have more opportunities to reengage. But yes, we are clearly in unusual times, and we're still seeing this payback from the period of lockdown and the pandemic.
Shepard Smith here. Thanks for watching CNBC on YouTube.